If you're ready for freedom from the grind, then passive income from real estate investing is the best way to get you there. If you don't know where to start or what to do next, then the Rent Roll Radio Show is the best place to get you there. Join us while we discuss the best practices, strategies, and mindset you'll need and give you actionable content to get you from where you are to where you want to be. Hey, Rent Roll Radio listeners, as always, I'm your host, Sterling Chapman. Today, we are joined by Brian Wagers with Elevate Commercial Investment Group. Brian, thank you so much for joining us, and we're excited to have you on the show.
Thanks for having me, Sterling.
Brian, can you give our listeners a little bit of background about yourself, kind of what you were doing before real estate and how you got to what you're doing today?
Yeah, so not a whole lot of background before. I got started in real estate pretty early. I got started, I guess, when I was about 24, 25. So before I was born in Cincinnati, raised there, went to University of Kentucky, got my economics degree there. And right out of college, I went right into sales. I was at a company for about 3 years. I was just, grinding it out, putting my head down, trying to grow my book of business in the sales.
What did you sell?
Logistics services, trucking. I was in trucking, like across the country. Shippers and receivers need to get trucks in and out of their warehouses.
Cool.
Yeah, so fast-paced industry, kind of rough around the edges, dealing with the trucking industry not always going right. So it was definitely good, built some thick skin pretty quickly, and learned a lot in sales.
And so how'd you transition from that into real estate?
Yeah, so at the time, it took me like a couple of years, but I started to, really get my footing there and have a good solid book of business. And I was maxing out my Roth IRA accounts, and I knew I had to do something with my money. I was working pretty hard for my money, and it was growing pretty quickly, and it kind of led me to think either the stock market or real estate. And I played my hand in the stock market, and I found out quickly how little control I really had in the stock market. And it wasn't really as quick as I thought it was going to be. I invested in like pharmaceutical company and GoPro at the time. GoPro went from like $35 to $5. And I was like, okay, this was way out of my control. I had nothing to do with whatever CEO decision made, or, it was very little in my hand. So that led me to real estate. Going into that, I knew a lot of wealth in America was created through, the stock industry or the real estate industry. So, that led me to real estate. I started, Bigger Pockets. A lot of people familiar with that. That's what kind of turned me on and got to real estate and got my brain thinking about that. So I got a single family home pretty quickly after I made the decision to get into real estate, and had that rented out, managed it myself. So that was my first ever real estate deal.
Awesome. And so how did you get from, your first single family rental house to working at Elevate?
Yeah. So right after I had that single family, it was going great. The guy paid me Venmo first of the month. He paid me $950. The rent was $450, or my mortgage was $450. I didn't have any 3 a.m. water bus horror stories. It was just way too slow. It was like, if I'm going to do this, it's going to take 10 of these, 20 of these to get where I wanted to go. So I quickly pivoted to multi. I knew commercial real estate, the economies of scale were there. And specifically with multifamily, you have the fundamentals of rental property investing, with the scalability of commercial real estate. So I pivoted quickly to multifamily. I located a 12 unit in the same market. I got started in my backyard here in Arkansas. So I got a 12 unit under contract. Then I found a 20 unit from driving for dollars, and had to sell it. The seller actually carried back the note. So at that point, I was at 32 units that I owned 100% of. Then I was able to refinance out of the first 12 unit and get into another 12 unit. So I added another 12 units to my portfolio. And I did that for a little bit, 12 units, 20 units. built up a portfolio of about 60 units that I owned 100% of. My girlfriend's dad at the time had owned some single family properties free and clear. And I had to, slowly, he understood rental property, had a large commercial paint contracting business, understood, real estate, but was pretty debt adverse. They'd been through, 2008 crash. But, I kind of showed them, the benefits of what I was doing and how leverage can be a good thing and debt and good debt can be a good thing. So he started partnering with me, and just the two of us, we built up a portfolio of another 450 units. So I was a main partner on those 60 units, and then the main partner on the 450 units that we partnered up with in my backyard of Arkansas, Northwest Arkansas to be specific. So Rogers, Bentonville, Springdale, Fort Smith. Some of your listeners might familiar with those areas.
That's a bold move, partnering with the girlfriend's dad, huh?
Yeah, we had to lay out the expectations. That's something. It paid off. He's doing really well with all our investments. We're selling 102 units actually tomorrow. That we're
still together, I assume.
Yeah.
Awesome.
Awesome. Yeah. Yep. So she's my wife now, and So he's making like 184% return on that, and that's going to sell tomorrow. But we've had a couple exits already, and he's doing well with those. So awesome. It was good working with him, because he is definitely very more hands-on than your typical passive investor that I work with now. It's very detailed to the numbers and everything. So it was definitely a good learning experience. When you're working with people, you'll get all sorts of, some people who want to be hands off, some people want to be hands on. So it was a good experience for sure. And it still is experience. We're still partnered on some deals.
So explain to me your relationship with Elevate and how that kind of came to be, because it sounds, a lot of times that we start kind of in similar ways as you did. We start buying single family houses, and we may partner up with somebody locally and buy a few more. And, there's always these opportunities to work with these larger operators. But then there's always also kind of this desire to be the larger operator. So tell me about how that relationship formed and why you decided, and kind of what that relationship looks like.
Yeah. So it was about, probably 2 years ago. I always had larger syndications in the back of my mind, that that's somewhere that I probably wanted to go. But what I was doing was working. We were knocking out deals. We got good systems. But, about a year and a half to 2 years ago, I'm in Northwest Arkansas. There's only so much inventory here. And I was starting to make offers. I was starting to see some of the same apartments that I made offers on, like when I first got started. It was coming back. Some of these deals were cycling back through, and I had made offers $500,000, $1 million less than what they're asking for on these smaller properties. So I knew I was going to have to branch outside of my market. So, I started to locate and look for other operators that were growing, that had some sort of unique advantage to other syndicators. And that's when I kind of located Elevate, and liked what George and Eric were doing with the team. I really liked that they had the in-house came from a construction background. When you're doing these deals, CapEx is such a huge important part of your business plan. Due diligence, finding stuff that I know I would be afraid to do, just because I had those experiences, going in on a 200 unit apartment complex, I might miss something that someone with a trained eye in construction would see, some sort of foundational issue, something that they could pick up and nail down on those experiences. So that really helped. I started raising for them on a couple of deals in Dallas. So I'm in Arkansas. I knew the story of Texas. Everyone's interested in Texas. It's a growing market. It's a great market. Most of the market's there. It's right next door to me. So I understood the story of Texas. So I started raising. I reached out to them, and we met at an event. George and I met at an event, and started really connecting there. So I actually raised on 3 or 4 deals with them where I was just the capital raiser for them before we actually, partnered up full time, where it wasn't just the company that I built, Wagers Capital, working with Elevate. Now it's, I'm just Elevate. Wagers Capital is Elevate. So that's kind of how, it was always in the back of my mind. I located these guys. We partnered on a couple of deals before we went full on committed to Elevate.
That's awesome. That's an awesome story. I love hearing it. I mean, and we all know the story, why we do the larger properties, right? Because 20% of a watermelon is a lot more than 100% of a grape. And the same thing can be said on the company side, right? Being a portion of Elevate Capital it allows you to grow and leverage all of those resources. That's an awesome story. What do you think is next for you?
Yeah, so Elevate's goal right now is 10,000 units under management. So that's the next step. I think you're always pivoting with your goals and targets. So that's our near one in the future. So my role in getting us there is going to be managing previous investor relations, making sure they're getting the communication that they deserve, make sure that I'm helping with incoming investors, make sure that I'm working closely with other capital raisers that we might bring in, working with Pref Equity Group, institutional funds that are going to be investing with us, make sure that the lending is connecting with our investors, make sure we have the full picture on pretty much the whole capital stack is what I'm going to be overseeing. With Elevate, they have so much experience in the construction acquisitions area. I knew that I could bring that value add to the investor side. I don't have to be boots on the ground in Texas or boots on the ground in South Carolina or Florida or wherever we may need to do a deal. I can be in Arkansas or I can go out to those sites as needed. But my kind of value add there was the investor equity capital side.
Awesome. So you are probably on the forefront of these conversations about economic forecast. I would imagine that's a conversation speaking with investors that you probably have more than anybody else in the company, right? So, this might be a few weeks before it airs, but I imagine that we're not going to be in any better situation than we are today. But, as of May 12th at 1:17 p.m., the interest rates are through the roof. The stock market's crumbling, cryptocurrency bottomed out. What is your kind of economic outlook for multifamily? And, I guess the kind of the topics we want to touch on there, like how do you feel like interest rates are they going to remain low or are they going to go up? How do you think cap rates are going to perform in the next year or two in relation to the interest rates? And how do you think that affects the liquidity in multifamily and the buyer pool?
Yeah, it's all great. It's a fast moving economy. It's, the great thing about multifamily real estate is it moves a lot slower than the rest of, when you see stocks go from, like I had 35 to 5, I experienced that. You're seeing a lot of people that are heavily involved in the stock market, suffer. If they were planning on retiring right now and planning on setting up a drip from their retirement account, they're not in a good position. So, as far as you're seeing more and more people, even starting from last year, more and more people that were looking to move out of it with the volatility of the stock market through COVID, after COVID. Now with inflation, you're seeing a lot more people looking at real estate as a avenue to diversify. So that's actually affecting multifamily real estate because there's a lot more capital chasing deals now. You're seeing these prices continue to be high. It's been happening for the past year or two. For every 100 deals that you're underwriting, maybe one is a good one, where before it might have been every 20 you think you might have a good one. So the good deals are getting more slim, but it's going to reward the people that are active in the space, that know what's moving, know where the market is going. As far as interest rates go, I think they're going to slowly, steadily climb. I don't think they're going to skyrocket by any means, but I do think, there's going to be slight increases in that, but I don't think that's going to outweigh the amount of capital that's chasing multifamily now. So multifamily has become, you're kind of insulated by how much more capital is going into multifamily. So you have a lot more exits now.
The demand.
You have a lot more potential buyers that you can sell to now that there's so much more capital going in there, and you can sell a little bit quicker than you could before. So you have that kind of insulation there with the increased buyer pool. You have people that were in the retail space and commercial office space that saw COVID, and they're looking at how multifamily performed. And so they're starting to look at multifamily as well. So I think that helps mitigate the interest rate rises. You definitely want to make sure you are underwriting for, you're getting conservative in your underwriting for refinance events in year 3. You're not getting a lower interest rate than what you're coming in at. That's for sure. So you want to make sure you're underwriting correctly for that and being conservative in your underwriting. We are underwriting for exit cap. You want to make sure your exit cap rate is higher than what you're buying at too. That's something that you might see some people fidget with the exit cap. What are we thinking we're going to be selling this in year 3 to 5? So you want to be conservative there with the exit cap rates. I still think that they're going to remain low for the next 3 to 5 years, but I think there will be I think there will be a correction possibly closer to year 5 in the single family space, not maybe as much as multifamily space, but you're seeing from these builders, if people, there's such a need for affordable housing and such a need for housing, period. You're seeing these studies where if you start swinging hammers today, nonstop, you're still not going to fill that need in 3 to 5 years. So I think the need for places to live are still going to outweigh the interest rate rises.
Absolutely. Couldn't agree more. So let's talk a little bit of just shifting gears. Let's talk a little bit about being an active investor versus a passive investor. It's a conversation we have all the time. One thing that I want to kind of dive into is because, I'm just like you, I raise capital from passive investors. But it's no secret that as an active investor, you can build wealth a lot faster, right, than on the passive side. So why might somebody want to go to the passive side versus the active side?
Yeah, I think, if you're doing real estate full time, you do have the potential to build that equity faster. If that's what you want your primary job to be, I think go for it, but don't be the person that was trying to get into active real estate for 2 years and still hasn't found a deal. You're losing that opportunity cost of what you could have invested in the meantime. So I think active, it becomes more of a job. But as far as passive, you might have a higher return on your money if you're building your business or, moving up in your company as an executive in a company or working on your growing business versus trying to chase down deals or chase down management.
It's so true. And, it's so funny. People always come to me and they say, well, I want to be an active investor. I'm like, really? Because I want to be a passive investor. Like I'm just hustling like this because I have to. Like if I had tons of money sitting in a bag that I could, that I could invest, I'd be giving it to you, Brian. I wouldn't be out here. You know what I'm saying? It's a lot of work. It is a lot of work. Pretty much any way you go about it, right? Flipping houses is a lot of work. Sponsoring large multifamily projects is a lot of work. And not only do people typically find out, in my opinion, that they don't want to do that much work, but you're right, they don't have time for it, or they're sacrificing, like people love real estate because of all of the like long-term benefits of being an investor. If you have a high paying job, don't give up your high pay. I say it all the time. I came from telecom sales, and it was like, well, if I quit my job and I manage the properties full time, well, then I could save this much money. I was like, well, I would rather sell broadband than manage properties. That's terrible. You know what I mean?
Yeah.
Like,
So
why
some
am
dial
I?
up.
I see it happen all the time. People give up like a good job and then they go become a real estate agent, and it's like, I mean, and not that real estate agents done a good job. I have plenty of respect for the real estate agents out there, but I'm like, you all you did was trade jobs. You didn't like go become a real estate investor, right? You're still grinding. So if you have I think for our target audience, me and yourself, I think the message is if you have a job that you're really good at and or you have a business that makes you a lot of money, like don't give that up just to come work somewhere else. There's a better a better way for you.
Yeah, 1,000%. It becomes a full-time job, and it's a good way to build equity. Like if you don't have the equity to invest in real estate, that maybe getting in full-time active flipping houses, that's a good way to build equity. Flip it, doing some wholesaling or an agent work, that could be your way to build up equity. But when you have a high pay, you're an executive at a company, and you're taking away time from that, you're having a lot of opportunity costs at your current position when you could be getting a higher return on your hour at that other business or position. So it depends at what level you are, and usually me and you are working with are accredited investors. So when you get to that accreditation status, 300,000, 200 to 300,000 and up, your income per hour is a lot better spent on continuing that path, how they got to accredited, and then continuing growing that. So I think it's just about the opportunity cost.
Absolutely. Now, what would you do differently if you had to start over again, Brian?
Man, I really like I'm 31 right now. So I would say I really enjoyed my path to get to where I am, and I really enjoy looking at the future of where I'm going. So I would say it's been a really good ride so far. So maybe thinking about going bigger quicker, which I could have started looking at doing the larger projects earlier on when I was building up my portfolio.
I guess the way the question is phrased is presumptuous, assuming that you would do something different. To better rephrase the question, what advice would you give somebody else who's just getting started?
Yeah, start thinking bigger. Yeah, I would say think big when you're getting started. Make sure you're taking that, not just thinking big, but doing the work. Like you can try some things, and it's going to take consistent hard work. That's what it is. It's not just a magic pill as far as getting started. But someone who's getting started passively investing, I would make sure you're vetting the sponsors, seeing their past deals, seeing how much skin in the game they've got. That includes how much equity they're putting in deals, but also their social image, their brand image. You have a reputation right now with the podcast. You're on podcast, so that's like your own skin in the game as far as your brand. You want to look at someone who's building a brand too. But you do have some people that have brands so big that they don't necessarily need to provide higher returns or as many touch points with investors. So I think finding what you're most comfortable with as an investor, figuring out what kind of assets you want to go after, what kind of partners you want to go after, what kind of areas of the country that you're looking at, kind of narrow down, get specific about where you want to go, I think are all important.
Absolutely. And I invest alongside, with skin in the game with every project that I've raised capital for. And I think that's important and will always do so. But what you had mentioned about the brand and that skin in the game, that's so true. Like when our chosen profession, our industry requires trust higher than anything else, right? Like we would all of the people I know in this industry would never ever do anything to violate that trust. And that is, that is the skin in a lot of game is our reputation and our brand. And most of the people in this industry, I know they would never do anything to violate that trust of the general public that they may be listening to in the future.
Yeah. I mean, your reputation is everything, especially when you're growing, you have a growing company, like that's vital, important to your growth.
Absolutely. So I want to hop over to our radio round, just 3 quick questions to help our listeners get to know you a little bit better. The first question is, what's your favorite book?
Think and Grow Rich by Napoleon Hill.
Awesome. I just got my assistant to read that. He was just telling me earlier today, he just finished it. So great book. I've read it multiple times. What is your favorite quote?
I would say go one more. I don't know if it was David Goggins or Jocko Willink, one of those guys who said it, but when you're tired, whether that's one more rep in the gym or one more phone call to, a lead, just when you feel like you're done, just try to go one more and put in that extra mile.
That's a great quote. And those are great inspirational guys. And you get extra credit on that answer because I didn't tell you at the beginning of the show that I was going to be asking that. I usually give my guests a heads up, but I forgot to. So
that's all good.
Awesome on having that on the tip of your tongue, because most of the time when I forget to give people a heads up, they're kind of like doing this number fumbling around like, I don't know. People could come up with a book on the spot pretty regularly, but the quote, unless it's written on your wall, people tend to be grasping at straws. What's your favorite thing to do when you're not working?
I like staying healthy and in shape. So, working out is pretty important to me. So whether that's going on a jog or walk with my wife and our animals, or, going to our home gym that we built, or, staying active with.
Awesome.
Yeah.
What animals you got?
So we have 2 cats and 2 dogs. We actually have a German Shepherd our German Shepherd passed in December, and we have a puppy that's coming a week from today from the same kennel. 2 dogs and 2 cats.
Okay, cool.
It's a zoo in here.
Yeah, my house too. I have 2 corgis, and we're getting another corgi today. So I want like a larger dog, but
yeah,
I just keep ending up with corgis.
Corgis are a good dog for the small dog. Sometimes small dogs are pretty yappy or not as friendly, but corgis, I've had some good experiences with them.
Yeah, for sure. How can our listeners find out more about you, get in touch with you, or learn from you?
Yeah. Anyway, I'm on Instagram, Facebook, pretty active on there. You can email me, Brian, at elevatecig.com, or you can go to elevatecig.com/resources. We've got a lot of cool information on there, comparing the stock market to real estate, some other free informational stuff on the website.
Awesome. Well, Brian, thanks again for joining. I really appreciate it. It was a great opportunity to get to know you, and I look forward to talking to you in the future.
Yeah, same with you, Sterling.
This episode was brought to you by Crestworth Capital. If you're a busy professional and ready to make passive income from real estate investing, then go to crestworthcapital.com, where you'll be able to download a free copy of our ebook to help you get started today. Until next week, happy investing.